Everyone, Ty Carr here, and we are doing the None of Our Businesses YouTube show and podcast. With me today is Jack DiMatteo, Mark Pallardy,
Hey,
AJ Wheeler,
how's it going, everybody?
And Charlie Zigman.
Thanks for joining us.
So we got a lot of stuff we're talking about today. Just to give you guys a quick overview, we've got young workers in China. They're touching fish instead of working hard. We've got a COVID relief bill, the employee retention credit, discussion of a very comprehensive article from Tony Nitty with a little quick summary, what we hope is a quick summary from myself. We've got a discussion of the weekly unemployment at year end came in higher than expected. And what we're looking at now at the beginning of January is a loss of jobs, not a gain of jobs. We also have a discussion of new federal Department of rules that were finalized on defining gig workers as contractors or not. And then we've got some discussion about, are you worried that you may be in a dying industry? Some advice to operators on that point. We've got talking more about federal tax policy on expenses paid with PPP loans, and that now that that's settled, what about state tax policies? Do we have a tax bomb there? And we've got discussion of the new economic stimulus outside of PPP and the employee retention credit, some other things we might want to pay attention to. And finally, looking back to an article on entrepreneur.com from 2019, the need to diversify your revenue stream, or do you really need to do that? It sounds somewhat prophetic, as it was before 2020, when many businesses did hit limitations on their revenue sources. All right, well, let's kick this off with Charlie. Tell us what you got, Charlie.
All right, so I've got an article we can talk about this morning from a publication I know we all frequent, which is the South China Market Post, and it's entitled Young Employees Rebel Against Chinese Work Ethic by Being Lazy, Refusing Overtime, and Hiding in the Toilets. They call it touching fish. And so this terminology comes from an ancient Chinese proverb that says that muddy waters make it easier to catch fish. And so the idea is that basically because of all of the sort of chaos that's going on and kind of because of how they feel that over time they've accepted more and more overtime and that sort of thing, but are getting paid not anymore for that increased work ethic. They've sort of banded together and decided that there's going to be this viral movement called Touch and Fish, in which everyone encourages kind of being lazy and trying to get away with doing as little as possible throughout your day. And so they did a research into this issue, and they found that it was more of a generational problem, and that people born in the 70s and 80s weren't as prone to this as people born in the 90s. And so I guess I wanted to get your guys' take on whether or not you feel like work ethic is sort of a generational trait, or is it dying? What do you guys think on this topic?
Well, actually, when I read the article, Charlie, it made me chuckle because I was like, wow, people halfway around the world, from different cultural backgrounds are, react the same way to getting paid less and doing more. I thought it was like a thumbs up kind of like from across the other side of the world to say, that's exactly what I think American workers do. And, I think, well, and not just American workers, probably European workers. I mean, I think it's a universal thread that, if you're not getting paid much and you don't have very much satisfaction or like skin in the game, as they call it, in a job, you are probably going to drag your feet, hide in the bathroom as much as possible, look on your phone, surf Facebook. I think we've talked about on this podcast before that a well-engaged workforce is one that, that is satisfying, not just financially. Of course, that's a major part of the pie there. But if you're just doing remedial, meaningless work, for lack of a better word, you're just not very engaged. And, it doesn't make people very productive. And I think this, and I think kind of an American, view of Asian workforces, that they're very like heads down, working all the time. At least that's like the kind of cultural view that I've had of the East, or the working conditions in the East. And I think Now you're seeing that that's not so much the case, and I guess rage is globalized now, or at least laziness is globalized if you're not satisfied at work. So I thought that was kind of interesting, I guess.
Yeah, and to add to that, I want to put laziness in quotes, because when I read through this article, the thing that kind of popped out at me is Generation Z abhors the so-called 996 work rhythm. They work from 9 a.m. to 9 p.m. 6 days a week. That's a 72-hour week. So even if they're looking at their phones on the toilet for a couple hours a day, that's still a damn long work week. So, kudos to you for taking what you need and practicing a little self-care.
On the surface, it sounded to me like the Chinese version of millennials. And it just made me laugh a little bit. My wife's Chinese, originally from Hong Kong. And, when that discussion inevitably comes up, my wife and I are similar aged. We're that generation before millennials. And so, and my wife's also in finance and accounting as well. And so, we inevitably have that discussion at home and with our friends about, those millennials and their work ethic here in the US, that's, it's different than our generation kind of thing. And my wife's comment in the past is, well, we don't have millennials in Chinese. And so it's, now I can go back to her and say, you're touching fish in China. It's not, you don't have millennials, you're touching fish.
I think perception has a lot to do with this, Mark. And you said, that's very interesting, that 996, because, they're actually accomplishing quite a bit. They're just not doing it in a traditional manner, and it's, to some extent it's generational, but I think it's generational, maybe even more from a perception standpoint. You kind of saw it when people with the workforce, like somebody said, it was very easy to be a manager in the 50s and 60s because you were managing people that had grown up in a depression and they would do anything you asked them to because they were desperate to keep a job. We're so far removed from that, and now people have more freedoms and more options. And if you don't engage them, to AJ's point, if you don't engage them, they're going to go elsewhere. But it's not, the perception's not that if you're not, we kind of talk about it with remote work, right? If you're not sitting in front of somebody, then you must not be working. Well, yes, they are working, but they're working, all kinds of different hours and all kinds of different garments, and they are getting the job done. So to me, I think a lot of it is just the generational perception of these.
The other kind of interesting argument that they had in the article against hard work was that there was a quote that said that if you work hard, your colleagues will find bad luck. And the idea is that basically if you find yourself doing the job of 3 people, then people around you kind of get either laid off or don't advance. And so I've never really thought of like working hard as something that would then take from someone else. But I thought that was an interesting kind of viewpoint. All right. Do you have another article we can talk about, AJ?
Yeah, actually, strap in. So for those who don't know, there was the new COVID relief bill was signed while we were gone over Christmas and New Year's break. And there was quite a bit that was in the bill. We'll get into some of the more, end cases in that bill in a little bit. But actually, Ty forwarded me 2 articles from a Tony Nitty from Forbes, and he really breaks down the new COVID relief bill and really the employee retention credit changes that happened in that bill in a 2-part article series that we'll link it in the description. And I think he did a very good job. It's very in depth for a Forbes article. It almost reads like an accountancy or a journal, like a white paper on kind of the changes. But so I kind of wanted to go over the highlights here and then maybe give from you guys, any extra or any kind of additional information you guys might have, because I think it's a dense and kind of, was quite a change that I don't think very many people are talking about. At least I haven't seen very much information out there. So the employee retention credit is essentially a for-profit or tax-exempt organization can claim a refundable payroll tax credit for up to $5,000 per employee for wages paid between March 12th and December 31st of 2020. But they need to, and also too, this bill created so that if you took a PPP loan and was extended for that 28 weeks, a lot of people found that they exhausted their forgiveness portion of the payroll portion of that pretty quickly because of the expanded time. And at the time, you either got a PPP loan or the employee retention credit, and you couldn't double dip on them, or you couldn't get both. Well, this new COVID relief bill actually undoes that restriction. And if you got a PPP loan, you're now eligible to be able to get ERC on wages for that happen. And it's retroactive. So you can go back to 2020, which is kind of interesting. But you either need to be shut down by a government order or experience a large drop in year-over-year gross receipts for 2020. So just to break it down, PPP loans were barred from claiming the ERC, as we just said. So no more prohibition on claiming both the PPP and ERC. But while a taxpayer may claim both, they cannot do it on the same wages or healthcare costs. So you can't double dip on the same wages. So if you use part of your wages during that time to get your PPP loan forgiven, you have to exclude those from your ERC calculation when you're going for this employee tax or employee retention credit. And then the last portion that I just kind of kid out, it says don't wait long. So I guess it extends the ending date for the ERC from December 31st to June 30th of 2021. So it was set to expire December 31st, 2020. They extended that to June 30th, 2021. And I found this interesting because actually I hadn't heard anything about this. I think the news kind of played up the PPP loan, access to PPP loan. Now you can get a second round, but I haven't heard much about this employee retention credit. And so I thought it was an interesting kind of part of the bill that I don't think even accountants are talking about. I haven't seen a lot, well, besides Ty's article that he's been writing during the week. So maybe if I missed something, Ty, or if you'd like to jump in and kind of expand upon any of that, I'd love to hear more information on it from somebody that's been writing about it.
Sure. Yeah, I think, I do have an article up on LinkedIn now. So for our audience, can go check Ty Carr out on LinkedIn and my articles there, and you'll see kind of a summary of the guidance that we have on the expanded employee retention credit now. But the article that we're kind of working from in this discussion from Tony Nitti is way more comprehensive, way longer and more comprehensive. So if you really want that deep dive, I think that article in Forbes is a great place to go. I'd say my article is more of a quick summary. But yeah, I think AJ hit right on it. The retroactive pieces. There is been some discussion. I think Tony is very emphatic, and other authors that I've seen have been in line with Tony that the pieces that AJ mentioned are the only retroactive pieces, and that the main retroactive benefit is the fact that you now, even if you took the PPP, you can actually go back into 2020. And if you otherwise would qualify for the ERC, you can claim it, right? And so that was the big thing, is that a lot of companies, in order to qualify in 2020, and I'll talk about this in two steps, because we have the ERC under the CARES Act, which was 2020, and now we have the expanded ERC under the Consolidated Appropriations Act of 2021. It's the new one, right? So I'll just refer to those as the ERC under 2020 rules and the ERC under 2021 rules. And so the ERC under 2020 rules was actually, there was retroactive pieces expanded that AJ was just mentioning. And that big thing was, well, under previous law for the 2020 ERC, you had to either have, you have to have a government mandated shutdown of some part of your business, either in partial or in whole, or you had to have a greater than 50% decline in your gross receipts when comparing to a quarter of 2019, a similar quarter for 2019. If you had any of those two things, then you could qualify for the ERC. That hasn't changed for 2020. At least that's the way Tony reads the rules from the Forbes article, and that's the way that I'm reading it as well, is that has not changed for the 2020 credit. What changed, though, is that even if you qualified in 2020, which many companies did, but then they took the PPP, they weren't allowed to then claim the ERC because they couldn't claim it with, they were prohibited from doing both programs. And what the new rules now say is, oh yeah, you can actually do both as long as you're not using wages paid by PPP funds to claim the ERC credit. And so, and given the way the PPP was already previously expanded in terms of how you go for forgiveness, it's highly likely that if a company would qualify for the ERC in 2020, they can construct the case that they can claim both the PPP and the ERC. So this is a real retroactive opportunity for a lot of businesses that would have blown past the ERC during 2020. Now there's a couple of tricks here, right? That we don't know what's going to happen if you're not careful about this. And one of them is that, of what I just said, you can only claim the ERC if you didn't use PPP funds in order to pay for the wages. So what that suggests is that if you're going to apply for PPP forgiveness, you want to be careful to coordinate with what you're doing with the ERC. You don't want to claim all of your wages as being paid through PPP funds if you can claim other PPP qualifying factors to get your PPP forgiveness and leave those wages unused for PPP so that you can claim the employee retention credit. So that's why a lot of us right now, like when we're talking to clients and others, we're telling clients who haven't gotten forgiveness yet, and they're asking, oh, is it time? You know, there are a lot of clients, a lot of companies out there are anxious to basically put a stamp on their forgiveness and have that behind them. And we're saying, hey, wait a minute, just wait. Don't do that yet, because if you could qualify for the ERC in 2020, it would be prudent to wait and see exactly how you're going to coordinate claiming the ERC with PPP forgiveness. And the logistics behind that, we don't know yet, because that requires the IRS to issue more guidance on exactly how do you coordinate those two things. That hasn't actually been issued yet. So we don't know exactly how those logistics. And let's throw out another thing we don't know. What if somebody already claimed their PPP forgiveness? What if they already filed their PPP forgiveness? You know, is there any opportunity to basically restate it and say, well, we would have gotten forgiveness even if we hadn't thrown all these wages on the forgiveness form, and therefore we should still be able to get the ERC? I just throw it out there. Maybe. I'm not here to say that there's not going to be some redress later for this. We just don't know. So I'd say prudently, when you don't know, if you don't have to, there's no reason to rush out and claim your PPP forgiveness right now because of this particular issue, if it's possible that you might get this retroactive 2020 employee retention credit. There were a couple of other retroactive provisions. Probably the most common one that would also be of interest to many companies was there was confusion under the prior law as to whether payments for healthcare would be included in your in what could be used for the employee retention credit base. And then the new law retroactively said yes, it could. And more specifically, there was some debate over whether, if an employee was not getting any wage whatsoever, if basically they'd come to a deal with their employer that they would just cover healthcare costs and that's it. They wouldn't be paying them any other gross wages, which you can imagine, right? Maybe the company's not doing well. They don't have a lot of cash flow. They're furloughing employees. They want to keep employees kind of on the team, but they can't really pay them. And so they come to some deal where we'll pay your healthcare for the next few months if you just kind of stay with us and we see how this thing goes together. You can imagine those scenarios, right? And there was some question there as to whether paying healthcare cost would be considered wages for the employee retention credit. And retroactively, that's been cleared up that yes, it would be. So that may be another opportunity where maybe somebody didn't think they would qualify because they had a bunch of that kind of income, or they didn't claim as much credit as they could have had they thought about that kind of income. And so there may be opportunity to go back and get credit on that as well. But the expanded credit, you know, and I'm running long here, guys, and I hope our audience bears with me because there's more to it here, right? Because we're talking the retroactive credit. The expanded version of the credit for 2021 has different rules, which expands its opportunity for a broader set of companies. And those different rules, one of the key issues was that 50% threshold that I mentioned, where if you didn't have a government shutdown of your business, you would qualify in 2020 for the ERC if you had a greater than 50% decrease in gross receipts. Well, for 2021, that's been changed to if it's a greater than 20% decrease. So the threshold's been lowered so that more companies can qualify for the employee retention credit. So if you found that it was like there was no way your business would qualify for the ERC in 2020 because you didn't have a greater than 50% decrease in gross receipts and you didn't have a government mandated shutdown, don't give up on the ERC, because for 2021 you might qualify, because if you didn't have a 50% reduction in gross receipts, you might have had a 20% reduction. And again, the basic there is the default is you're comparing against quarters in 2019. But that was another change for 2021 is they said, hey, we'll even let you go after this if you didn't exist in 2019, or if you only started in 2019, we'll let you go after this. You can take your 2021 quarters and compare them to 2020 instead, if that's your situation. So there's a lot of expanded opportunity. That's probably one of the bigger places where the opportunity is expanded. There is some more expanded opportunity for companies, because it used to be that you couldn't qualify for this if you had more than 100 employees, and that threshold has been raised to more than 500 employees. And so how they're defining what a small business is there they've widened the net a little bit on that. The other piece is the amount of the credit has increased for 2021. So in 2020, the credit was basically up to 50% of qualifying wages. Those qualifying wages per employee could not exceed $10,000. So no matter what the employee's wages actually were, you could only claim the credit on up to $10,000 and only up to 50%, which meant that you could only get up to $5,000 per employee. And the way the law was written is you could only get that amount per employee for all quarters of the calendar year. So that was it. Like for the entirety of 2020, your employee retention credit could never be more than $5,000 per employee that you were going to claim this credit on, right? Well, for 2021, the credit is now 70% of up to $10,000 of qualifying wages, with this change of wording to for each calendar quarter in the covered period here. So basically the threshold has gone from what could have been $5,000 per employee in 2020 up to $14,000 per employee with qualifying wages for 2021, because you can claim potentially up to $7,000 per employee per quarter if those employees and those wages qualify for both Q1 and Q2 of 2021. So those are some of the bigger changes. So bigger credit, more expanded opportunity for people to claim the credit in 2021. And then, as I mentioned earlier, the kind of the weird controversy, I think most of us are reading the law to say that the addition to the credit, the expanded opportunity of who can claim it and all that, and the 7,000 per quarter, all those parts of the law, it seems to me in reading it, and that's what you would find in reading the Forbes article from Tony, is that those pieces only apply to the 2021 credit. But there have been a few commentators who have said, if you read that law just right, you might see those provisions as applying to all the way back to the 2020 credit. So it's possible we might get some other guidance on that, but I would say conservatively for our viewers and our clients, let's just assume that those expanded provisions only apply to 2021 from now. And if we get better guidance on that later, that is favorable on that point, then huzzah, we got some more there, right? But that's the quick summary on it. And yeah, if you guys have any questions, I'll field them.
I have a quick question, Ty. When a client, like when somebody goes to apply for forgiveness, and for instance, I've had this question. There was a client of mine that just couldn't wait. They couldn't wait, and I don't think they would qualify for this ERC, but they just couldn't wait. They wanted to submit their application for forgiveness, and when they submitted it, they went ahead and you had that 28 weeks expanded 28-week period. So when they went and applied for forgiveness, they went ahead and just chucked all 28 weeks of payroll at that forgiveness with the rent and with, just as a backup. Like, I don't want to have any questions from the bank. Here's more than enough wages. Here's more than enough healthcare. Here's more than enough rent and utilities. Does that then make those wages that they threw at that forgiveness ineligible from this ERC calculation? Would that be considered double dipping because they put it on the form as a forgiveness amount?
Yeah, presumably, I would say, and that is why we're telling clients who could qualify for the ERC to not do that. Don't rush to file for your forgiveness until this has been analyzed. But I say presumably. The real answer is exactly the case that you're making. I don't know for sure that the IRS won't give us some kind of safe harbor or redress if people just threw wages on their forgiveness application with the SBA that they technically didn't need in order to get forgiveness. Can we then claw that back and claim it for the ERC? Does simply putting it on the forgiveness form then disqualify you for the ERC? I think that's going to require further guidance from the IRS to know for sure. But I would say, no point, don't do it. if you haven't filed for forgiveness yet, just don't do it to begin with. And then you don't have to wait for guidance from the IRS to save you on that point.
And ironically, and this may be beneficial, if you have a smaller bank, I know that some banks, they've been claiming that they're going to have the forgiveness portal up, but some banks haven't even started taking forgiveness applications yet because they're waiting, I guess, for a final ruling on all this stuff. So I think if you have a smaller bank, usually I found this to be the case with smaller like credit unions or banks, that they haven't actually opened up for forgiveness. So I think maybe, like if there's no harm in waiting, I guess, to file for forgiveness. Is that what we're saying?
Right. Yeah. I think, there's no reason to get over anxious about it. You're going to get the forgiveness, as long as you meet the legal qualifications. There's no reason to try to get it done early or get it done ahead of time. And while there's still these unknowns, I would say it's worthwhile waiting. And, for what it's worth, I think the advice given previously to wait was good advice, because one of the things the new law, outside this topic of the ERC, one of the things the new law did with PPP is kind of that they come up with a simplified one-page application and to simplify the whole forgiveness process for loans under 150. And that came out as part of the act as well. And so the people who waited are going to have a simpler process, presumably, for applying for forgiveness than those who kind of rushed in to try to do it under the old rules. It's funny, I see some of the same things happening, though. I think with this PPP second draw, I'm seeing, this is off topic of the ERC article, but on this point about rushing in to get your PPP forgiveness, I'm seeing commentators and people out there posting daily about, oh, the application's available. Oh, we can see what's on, like this is something we didn't need to know within the 24-hour news cycle of what the exact application that the SBA has, that their bank hasn't even rolled out yet, and that we're saying you probably don't want to rush to fill out right now anyway, right? But I still see commentary out there that's acting as if this is really important to have up-to-date information about the latest application coming out, and that's what we saw. We saw this 6 months ago when the SBA, or more, when the SBA was first coming out with the first round of PPP applications, is people rushing to get those forms and try to fill them out, and and I see kind of history repeating on that to some extent now again. So I'd say just slow down, everybody. As long as you're within your time period, which you all should be, there's no reason to rush out and claim your PPP forgiveness.
Can I ask a follow-up just from questions that are starting to come down the pike about PPP round 2, because people are looking at borrowing money for the second round of PPP, but if we match that up against the ERC, does it make more sense to just maximize out your PPP and figure out how much it is and then worry about that ERC portion if you go over that amount that you're spending? Or should you try to game this and figure out the exact right amount, and maybe your lower wage earners, you move them towards ERC, and your higher wage, you figure them towards PPP? I guess I don't know how the second round of PPP works well enough to understand how to advise clients, because there's a lot of angst too, because we saw in the first round, they ran out of money and then people freaked out. So there's a lot of people wanting to jump right on getting second round of PPP while it's available.
Yeah, I think that's a good question. I don't know the complete answers to that. I'll frankly, I studied the less sexy parts of the law, the income tax, the fact that we don't have to pay income tax on the or the fact that we get to deduct for income tax now the expenses paid with PPP and the ERC. I intentionally studied the less sexy parts of the law, knowing that PPP2, the second draw, would be well covered. So I'd say I have not come to the table with a complete understanding myself of that, but I think some high level thoughts that I have about that are that is that the planning of coordinating between the ERC and PPP happens in the forgiveness application piece, as opposed to the initial application for PPP. I mean, similar to the last application for PPP, you're basically applying for funds based on about, I think it's still based on like 2.5 times your qualifying expenses or whatever. And I think that whatever you're submitting in terms of applying for the funds on that front end is not determinative of why you're claiming forgiveness. I think because forgiveness is like a second step with a separate application. So I don't think you don't necessarily have to coordinate your application to get money with the ERC. It's the forgiveness piece that you would want to coordinate with the ERC. But then what you mentioned, I think makes sense to me. I haven't thought through it, but the idea that, it may be that you're choosing particular people with particular roles and rates of pay to apply to the ERC versus to apply to the PPP. I think something like that might in fact make sense. What I know, or what I believe from the original PPP, if we're dialing back to 2020 and we're taking advantage retroactively of the idea that we could potentially claim the ERC, I think that there were most businesses that I'm seeing, there's like no question, right? Like there's plenty of expenses there for them to get the PPP forgiveness and leave costs left over to claim the ERC. But I think what you said is exactly right, is that, well, if you're on the margin and you're only leaving a certain amount of wages left over, I guess you want to leave enough left over that you can get the full 14,000, right? Is kind of how you want to look at it. But if it's just a 1-for-1 trade-off, if it literally came down to like, we only have one employee that would qualify us for the PPP or for the ERC. And your question is, should we claim the PPP and get forgiveness based on their wages, or should we not do that and claim the ERC? I'd say for sure claim the PPP, because you're getting full recovery of those wages potentially through the PPP, and you're only getting up to $14,000 on the ERC. So for sure, if it really comes down to which one to, if I can only claim one on the same thing, I would claim the PPP.
I would also mention that one thing I noticed in reading the new PPP loan round 2 rules is it kind of disadvantages nonprofits. And Ty and I had kind of talked about this, but the requirement that you have to have 50% less receipts than a year ago. And I think during this pandemic, a lot of money has been thrown at nonprofits, whereas opposed to like the first round, you just had to certify that you were unsure of your economic future. Now you're talking about a true, calculation that you got to show receipts are down. And a lot of nonprofits, I think, had, at least the ones that I've been working with, have seen either a steady, no increase or decrease kind of receipts, or an increase in receipts. So I think this round will really go more toward those small businesses as opposed to the nonprofits of the world, I think.
Yeah, and I suspect, in the conversations that you and I have had about that, AJ, is that it would depend on, it would really depend on the type of not-for-profit, their source of funding and things like that. But it's not, I think your point is, a lot of people think not-for-profits automatically just don't have money and so they're going to automatically qualify for something like this. And some of the ones that you see and been working with, they were able to maintain their funding because the nature of where their money comes from. And, if your money comes, if you're a not-for-profit and you get a lot of money from program fees that require you to be open to the public in some way, you might've been hurt by some shutdowns, right? But if your money comes from grants and donations, and your donors and grant makers were still coming to the table, you weren't necessarily on a gross receipts basis affected and in that way. But we'd say, just like with the small businesses, keep in mind that the threshold from 50% went down to 20% for 2021. So if you had if you were not for profit with a modest decline, you didn't meet the 50% threshold in the prior year, you might meet the threshold for 2021. One thing I'll throw out there, and maybe it's an article we can look at for our next podcast, AJ, is that there was a provision in the new act to be more to basically clarify what gross receipts mean for a not-for-profit. And I haven't looked at that, but that might be an interesting thing for us to look at in the next time we cover this.
I'll put it on my radar because that definitely sounds right up my alley. So.
Yeah, and I'm going to say one thing that may be a little unpopular here, but if you have a nonprofit that is continuing its revenue and hasn't gone down, the Paycheck Protection Program is to protect businesses that have had a reduction in income. So if they don't need it because they haven't had the reduction in income, then frankly, they probably shouldn't get it.
Yeah,
So.
and they were in a group of not just nonprofits, but a bunch of other businesses who actually thrived during the pandemic, which was the minority in the overall picture, of course. But there were different types of businesses who kind of had a very pandemic approach, who had a business model that was really safe for the pandemic. And so, yeah, that's really interesting. It seems counterintuitive to not want to give more to nonprofits, but yeah, if they're part of a group that is overall doing better, that's an interesting point there.
Nonprofits aside, everybody loves free money, right?
All I'll say is this: if this doesn't sound like a typical government program, I don't know what does.
Jack, you got an article for us you want to throw our way?
Yes, I do. I've got one that actually goes back a couple of weeks. It was the end of the year, and they were talking about the weekly unemployment claims, and once again, they came in a little bit higher than they anticipated, but it kind of dovetails into what was a headline today because a jobs report came out today, and basically we, instead of gaining 70,000 jobs, which was forecasted, we lost another 140,000 jobs. So I just think it's an affirmation that the war on Main Street continues. Stock market to the stock market, no news seems to be bad news. It goes up every day, regardless of current events, regardless of what you see happening on Main Street. Corporate earnings. Again, it's like somebody said, you can't go to Flower-Rama and get your flowers, but you can still get them at Walmart and some of these other places. So again, like I said, it just seems like the war on Main Street continues, and it's just not getting the attention that it should.
It's interesting. I was just reading an article that somebody was speculating that the stock market is ripe for a bubble pop. And I think probably, it's, and I also read an article where unemployment kind of stayed steady. And this is the first time in the last 8 months that it hasn't moved the needle either up or down. And so I think it's interesting. I think our indicators, and we've said on this podcast, we probably thought that a recession was inbound, or at least a slowdown of the economy. And I think all of the stimulus, either checks or unemployment benefit extensions and all that other stuff, has kind of staved the tide and kind of held the waters at bay, I guess. But I think we're coming to an end of that time. And I think probably if we're looking at, if we're talking economic forecasts here, I don't know that there can be much more done to stave that off. I think it's probably an inevitable at this point that probably we will enter a recessionary phase in the economy, and those are probably just the key indicators of of what's to come. So, but I could be wrong. I'm not an economist, so I don't know.
Yeah, I think the discrepancy between Main Street and the stock market is, I guess, for lack of a better term, disturbing. I don't know what to make of it, and I mean, okay, great for those who are invested in the market and have seen some gains here. But for my money, it's if I don't understand something, I'm pretty reluctant to jump into it. And I don't understand it. I don't understand the market. We've had political issues over the last week here, and the market hasn't reacted in a way that you would think it might. And so it's just hard to understand. And I think that, like I said, if I don't understand it, then I'm, even if it looks good just on watching the trend, to me, that's like playing in Vegas. That's not really investing. And so I can't invest when I don't understand it. So I'm hungry to understand this disconnect. And that's my 2 cents on it.
I would just add, and gosh, I'm going to be the optimistic one here. What a shock. That I think what I've been hearing about the market recently is that it's preparing for a president and a new economy where the president is much more interested in injecting stimulus into the hands and the pockets of average Americans. So if he is successfully, this would be President-elect Biden, is able to successfully get more money other than the $600 into the pockets of average Americans, and they get out there spending, this is going to limp the economy along better than waiting 6 to 8 months for them seeing nothing and no activity whatsoever. Obviously, no crystal ball, but that's kind of what the stock market does. It just speculates. And, It's been wrong many a time. It could be wrong this time, but I'm holding out hope that some more money gets injected in the economy that keeps small businesses afloat and keeps people spending. And, at least our good friend Elon Musk, I have to mention it, is now the richest person in the world. He overtook Jeff Bezos today. So there you go.
Did you see Elon's tweet on that? I think that was great and classic of, yeah. So somebody tweeted that and he responded in Twitter, huh, that's interesting. Okay, back to work now.
Well, I think if the stock market has proven one thing to us, it's that the crack. It's like crack to the stock market. The 0%, the stimulus money, the 0% interest. You kind of saw it midway through Trump's term, when the minute they started to try to raise interest rates, economy didn't like it. So, that's what the stock market's reacting to, and it's worked for the most part for the last 12 years. Save the COVID scare, but again, to AJ's point, I mean, and Ty, I just something just doesn't add up to me. At some point, it's getting a little ahead of itself. At a minimum, it's getting ahead of itself.
I'll say it. It seems fugazi.
Yeah,
there you go.
One more thing about Elon, though, I think maybe this is the first time in history that the world's richest man is able to solve differential equations. So I don't know. Interesting thought. Food for thought.
There you go.
How about you, Mark? You have an article for us?
Yeah, I've got an article from The Verge, and this goes kind of back to one of our old favorite conversations. The Trump administration finalized a rule that could define gig workers as contractors. So in the past year on the podcast, we've looked at Prop 22 in California and some other things as to whether we have gig worker or employee when it comes to certain jobs. And the Department of Labor proposed a new framework that focuses on two core factors for distinguishing whether somebody's an employee or a contractor. One is the nature and degree of control over the work, and one is the opportunity for profit and loss. And I think that sort of defines or helps tailor make, like an Uber driver or Lyft driver, do they have a degree of control over their work? Sure. Do they have an opportunity for profit and loss? Sure. The more you drive, the more you make. So they're really leaning in towards allowing people to become gig workers and away from the employee mindset. But the one thing this article does say is we have a new administration coming in, and these rules could be changed in the other direction just as quickly. So curious what some of your guys' thoughts are on this.
Yeah, what I thought was interesting about this article is I think it muddies the water even more between a state differential of who they consider an independent contractor and a federal one. I think it even makes it more murky as to what you consider somebody on a federal level could be different from what you consider them on a state level, and how those differences, arise. And I think I don't know, I guess it's job security for anybody out there that's an employment specialist, or a payroll tax specialist or something that, to put time into this. But I just find it funny that it's kind of a back and forth, like a state versus federal kind of issue here. And they can't get together on the same page over any of this, depending on which state it is and which federal mandate it is, depending on if they're a gig worker or a full-time employee. So it's anybody's guess at this point, I think.
Well, and it's too bad that they can't set up a system that's complex enough to allow people to make their own choice about how they want their employment to look. It'd be great if the big, giants like Uber or Lyft could have an option to where people can choose to work on an independent contractor basis, and that would have certain characteristics. And then they had a program that was for people who, deem themselves to be employees, and it had its own characteristics. That's probably not practical in most businesses, but I think if there's an entire piece of legislation being written around, Prop 22 around this exact issue, it seems like the choice should be available to people in an ideal world.
Yeah, I think my 2 cents on it is that criteria of they have the opportunity to make a profit or a loss. I think that's a very interesting way to define it. I like that idea in terms of that as a criteria, and I haven't really heard that framed that way before. I think the other rules and the way they've been cited in the past have basically been trying to get at that issue to some extent, but that, I mean, that really gets at the principle of it, right? That, you know, if you're an employee, you typically, it should be impossible to generate a loss. If you're an employee, that for every hour of your time, you should be profitable. But if you're actually running a business, it's possible that that your costs could overrun your profits and your income, and that you could actually generate a loss. And so, you know, you think about that with the Uber driver, for example. You know, even it's possible to generate a loss as an Uber driver. You know, with what limited fixed costs you have for your vehicle and other things, if you don't have enough revenue from doing enough rides, you could, in totality, have a loss if you're actually operating as a business. So I like criteria that really kind of hone in on the principle of something, and that strikes me as something that really kind of hones in on that principle and doesn't leave as much wiggle room by just following very specific rules or guidelines that maybe you can get around but still not meet the principle kind of thing. So I like these kind of principle based ideas, and yeah, I just say, yeah, thumbs up to that one. I think that's a great way to look at it.
Well said as a U.S. GAAP accountant, Ty. You know.
Yeah, one other thing I want to comment that Charlie said, it's a little off topic, but I really like this idea of allowing people to choose what they want to be, because I work with some nonprofit companies that have volunteers, and the volunteers want to come in and do specific things, but they're not allowed to do things that employees get paid for. Because if they come in and they do things that employees get paid for, they could be deemed by the IRS to be employees, because you can't have somebody doing the exact same thing as somebody else for free. And even if that person chooses, no, I'm retired, I'm on a fixed income, I just want to come in and help, do something, you have to say, no, that's a paid position, we can have you do this instead. And it feels like it takes, just because of some tax code and law, it takes the ability for an individual to say, no, but I'm volunteering to do this, and it creates a sticky situation. So just thought I'd throw that in there. Charlie, I think you're up for our next article.
All right, so I found an article in Harvard Business Review. It's called "Worried That You Might Be in a Dying Industry." And so what it's all about is that every business sector is, of course, in precarious place right now. And so a lot of people are worried about their jobs and their careers, and even more so about entire industries. And so the article tries to give some advice that business owners and employees can kind of think through when they have that fear. And so the advice it tries to give that is practical that you can use is to focus in either your firm or in yourself on transferable skills. Ask yourself what you're really capable of doing. Make a list of those kind of more abstract capabilities, and then innovate from within and kind of think about how your company or you could evolve in your industry. And I know that, as you know, for us, we're all working in accounting, and so it's not an industry that we feel is dying in any way. But of course, we work with other companies that are in different industries that have different challenges, and we all come from a background of other industries as well. So I kind of want to get you guys' thoughts on, are these the right things to be thinking if you feel like you're in a dying industry, and or do you have any advice to people who are in that position?
I think when I was reading this article, one of the things that struck me was that transferable skills. And I thought of it more as like job seekers or somebody that's changing industries or something. And it's one thing that we used to harp on when I was part of the Beta Alpha Psi, the accounting fraternity honor society, was a lot of people didn't have any accounting background, but they had like customer service backgrounds, or they didn't even know they had accounting specific skills. Like they used to work a cash register and would do a cash drop every night. So they had reconciliation skills that they weren't identifying on their resumes, or, just customer service skills. Quick little story. I had a friend that went to law school, and one of the reasons she got picked for her internship at a large law firm was the fact that she had retail experience. And she was they were really impressed with her retail and customer service skills over anything with her. Of course, her grades were good and such, but they really honed in on that person-to-person skills and interpersonal skills, writing skills, communication skills. And so I think transferable skills in any industry, I think, are are a good thing to put on a resume, and to dig deep into what you've done at a job or what you've done in your work history to find things that are, not industry specific, and things that are intangible skills or even hard skills that transfer over to other jobs, for if you're looking to make a change, or even if you're just looking to bolster your own resume. I think those are things that are often overlooked by people. They just think that they're not in an industry and they don't have experience in an industry. But if you look deep and you look, through your job history and what you've done, I think it's probably pretty easy to find commonalities between, a customer service representative job and what you would be doing at even an accounting firm or a sales firm or anything like that. So I think that transferable skills really rang true to me. And I think we could all do more to look at those transferable skills when we're looking at our resumes or what we bring to the table for a job.
The transferable skills is a double-edged sword, taking kind of perhaps a unique thought on this point, because I think, as I listen to AJ talk about that, I think that's right in the sense that most people's job functions have transferable skills that actually could be transferred into other industries. And so it's often more of an activity of being able to identify that, knowing enough about the broader business world to know what it is in your industry that is similar in other industries, right? But I would also make that point that the thing that gives you transferable skills is also the thing that also makes it so your industry is not immune from being hit by artificial intelligence and automation and things of that nature. So it could be, in fact, that your job function does in fact have transferable skills, but that's the root of the problem, that your job function at a company is actually highly automatable. And so you might think you're in an industry that is immune to being wiped out. You're not in one of the highly listed industries that's going to be affected by automation. But when you look at your actual job function, it's something that could be automated. It's being automated in other industries. I think you have to look at that point and say, well, yeah, my industry as a whole maybe isn't going away, but what I do in this industry is going away in other industries when you start making those comparable skill kind of comparisons. And so, I shouldn't assume that my industry is immune to that. There's parts of my industry that will go away too. And I think I think it's going to be a pretty rare and unique industry that isn't hit in part by the wave of automation and artificial intelligence.
Well, and the authors kind of point to that, or way of saying that is that if you're in an industry that you think is going to get eaten by change, perhaps you should be the one doing the eating. And so I think that's kind of a really salient point, because if you look at that example of the job being so easy that it's automatable and that's the transferable skill, well, if you're changing what you're doing so much that that's not relevant anymore, then you're doing the eating in the example. And so, yeah, I thought that was a relevant quote.
Yeah, and I think also some soft skills. I know I've been on the hiring side of the equation on a number of occasions, and there will be people who will come in with accounting skills, but the most important skill to me is common sense. And I would give common sense skills tests just to see if people can work their way through a problem that they know nothing about. Because coming to the table, you can be the most book learned person in the world, but if you can't think your way through a problem, then it's problematic for the industry and for the specific job you're applying for. So I think getting some of these soft skills and being able to present yourself, and maybe becoming a little more media savvy and being able to present yourself in a way that's attractive to other people, sets you up as much as having these transferable skills does.
I agree with the transferable skills are one thing, but I think a lot of this has to do with, some of the ways companies hire now. And, so much of it is screened. They're not looking past, certain buzzwords, certain industry buzzwords, certain skill sets on resumes. Something I find very interesting, and I saw it firsthand. I worked at a company supporting business travel. So I've talked to quite a few business people in business travel, and I mean, up to 80 to 90% of the people that worked in that industry are now trying to do something else. And I would just have to think that, somebody that sits there, working a front desk at a hotel or planning banquets or some of these things they're going to be a natural for some of these other ones with just dealing with people all day, making difficult decisions, making decisions on the fly. I think a lot of those things are going to be transferable to many different industries. But I think one of the biggest roadblocks is, and I'm one of these people that believes it is up to you to maintain your skill set. I mean, you can argue back and forth that, you know, a lot of people say, hey, my company doesn't train me. Well, guess what? If your company gets rid of you in 10 years and you haven't updated your skill set, it's not going to be your company's problem. It's going to be yours. So I'm a big believer in keep your skill set, get those certifications. They follow you, not the company. And again, like I said, I'd like to see more hiring managers have an open mind and quit relying a little less on software that looks for buzzwords.
Yeah, I would also add to the list of those kind of transferable skills, you know, as you guys are brainstorming about that, I think the common sense, as Mark pointed out, I think that would be right at the top of my list. I think the other one that most companies are looking for, which is interesting because it bridges with what we talk about with, it provides a contrast with what we talk about with service providers who want to be advisors. But what most companies are often looking for is the skill of taking ownership, which is like a weird thing to call a skill, right? But it's like that willingness to take ownership of the problem and work it. You know, you may not be the expert, but you're going to work the problem and stay with it until it's resolved, and you own that problem, and you're going to do what it takes to get something done. That's, you know, when you're working inside businesses, I find that is like a key thing, right? It's like, well, if you have that and common sense, that can overcome a lot. That can overcome a lot of not necessarily having the technical skills, as long as you're willing to kind of get in there and fight in the trenches to make sure something is done. On the flip side, you know, being a technical expert, but kind of having the position of, well, it's not my issue. You know, I've done my part and I'm out, or I'm not taking full ownership of this. I'll do what I can, but at 5 o'clock, I'm out of here, kind of thing. You know, we know a company, typically they're not looking for that. But I would contrast that though with being an advisor, because I think that is the thing, is that there is a point at where what the value you bring to the table is advisory. And so, you know, when you're hiring an advisor, that kind of extreme ownership is not necessarily the key issue for you at that point. You are looking for somebody who has a lot of technical competence, usually in the advice space. So my message then to people who are working on their careers is, look, if you're the kind of person who takes ownership, there's a lot of opportunity for you. If you're the kind of person who doesn't want to have to take ownership, get really good at whatever it is. You got to be, know your shit, get really good at whatever it is you do. And then you can afford to take that attitude, right? but for those of us who aren't at that level, you gotta have common sense and take ownership of things.
I think either way, you have to consistently and constantly level up your skills, whether that be technical skills or problem solving or ownership skills. I think would serve you well all the way around. So, all right. So the next article I got was out of CNBC, and it's Advisor Insight. Small mom and pop businesses that took PPP loans may face a surprise tax bomb. So this relates to the fact that the expenses, and we talked about this earlier in the podcast, the expenses that were claimed for PPP loan forgiveness are forgiven on a federal level and are able to be deducted expenses for a federal tax purpose, but states haven't necessarily defined whether or not those expenses will be deductible on a state income tax. So for those, and this provides like a conundrum for both tax advisor or tax preparers, and then the tax paying either person or business, is that you may have a different amount of taxable income for a federal return as you do a state, and a lot of states haven't answered this question yet. So I thought it was an interesting conundrum, and kind of it's a state by state kind of I guess situation as to whether or not they're going to allow those expenses that were used for PPP loan forgiveness and essentially paid for by a PPP loan to be forgiven on a state income tax return for a business. So I don't know if any of you guys have looked into this or have any opinions on it, but I'd like your insight on it.
I mean, I think it's interesting because some states choose to fund themselves primarily through a sales tax and others do through an income tax. And so it definitely seems interesting as an idea that this benefit given to the entirety of the US would affect and impact the state's kind of budgets and incomes in a different way. And that seems not intended. So I kind of feel for the states on that side of the issue. But yeah, I'm curious to hear what you guys think about it.
I'm just glad you raised the issue because this wasn't something that I was thinking on my radar. I was kind of like probably most small businesses, whew, the federal issue was settled. But yeah, you're right. I mean, the article is right in the sense that, yeah, I guess there is still kind of a time bomb out there, or a tax bomb. We were saying a tax bomb potentially out there at the state level, where the states have income taxes if they're going to stay in line with federal policy now and say it's not taxable, or that the expenses paid with PPP funds are tax deductible, I should say, or are they going to diverge and say, nope, we're not going to follow that because that creates a loss to state revenue that we can't handle. So yeah, I think we have yet to see comprehensive state guidance on that.
Yeah, and if you have multi-state companies, then you've just opened up a hornet's nest that it's like, is it deductible here? Is it not deductible there? If I had workers who worked in 2 states and one state allows and one doesn't, it's just like, it makes one's head spin. And again, job security for the accountants. I guess since mine's PPP related, I'll go with my next article. And the article I have is from Accounting Web, and it says new IRS stimulus tax breaks and economic relief. Now, we've talked about the PPP and we've talked about some of the other aspects that come with that and the employee retention credits we discussed at length. But there are some other smaller provisions that I kind of wanted to get your take on, because I didn't know these were tucked away in there, but in a 5,500 page bill, of course they are, because, there's lots of little things that we can take advantage of. One of which I thought was interesting was that for those who take the standard deduction, you're allowed to deduct now $300 in charitable deductions on your tax return this year. So they're just to allow people to be more charitable, even if they're taking this larger standard deduction that's now allowed. Medical expense deductions used to be at 7.5%, got moved up to 10% of your gross income, back down to 7.5%. So somebody who's dealing with COVID who has high medical expenses might be able to take advantage of that this year. There's some family and medical leave stuff. Business meals have been at 50% and now potentially at 100% for a while. So there's lots of little pieces to take advantage of within the tax bill. I would encourage you guys to follow the link in the podcast notes, just to see what some of these are. But of course, if you have a complex tax situation, probably best to have somebody look at your taxes this year and see if you're taking advantage of all the things you can, because there are some little gifts in this stimulus package. Any thoughts from any of my compatriots?
I think that's great to bring up. I don't have all of them at the top of my head either, but yeah, I would just kind of make an kind of a editorial comment or a cynical comment on, such, typical tax policy. And it goes, you mentioned it earlier, Mark, more work for accountants. It's like, okay, from what you just said, so we can take a standard deduction, or we can itemize deductions, or now we've got a third option. We can take a standard deduction plus a $300 charitable. So standard plus deductions, right? So just create, and that's the thing. I think I'll say this for my colleagues that are in accounting. That's one of the things that's always driven me nuts about individual taxation, is that the amount of rules and changes and variance involved in individual taxation is just mind-numbing. I mean, there's just a lot of different stuff, but the dollar amounts are always like, they're not that big, right? So it's like, from a business standpoint of being in the business of being an accountant, it doesn't really pay to know this shit, because it's like, yeah, I could advise people to take an extra $300 deduction, which amounts to what, right? But I'm actually expected, I say it doesn't pay to know that, but I'm on the flip side, I'm actually expected to know that because I'm an accountant, right? So there's like a heuristic of, well, maybe I'm not a good accountant because I don't know that. And it's like, well, no, I don't know that, because me telling you that doesn't lead to me being able to bill you a lot more money or anything, right? It's, not, at least not directly, right? And so, yeah, that's always been an interesting paradigm. So that's one big way of saying that's why I've always been like, on the individual income tax stuff, and I'll just stick with businesses, because you have, there's a lot more upfront investment to understand business accounting and everything that goes into business taxes, but you don't have the sheer number of variance and constant changes in the business tax end of things that you do in the individual tax end of things. So that's my rant on all of that. But otherwise, yeah, good call out. Certainly, particularly, this is something individuals should know in some way.
That frustration, it's a typical bureaucracy. They just cannot help themselves. So, to your point, how much effort and legislation goes into writing something like that, which at the end of the day, what's the net effect across the population? You kind of see it also with the PPP loans. How many times have they argued with, the under 50,000, just sign an affidavit and we'll forgive it. But they just cannot help themselves. They cannot make anything easy, and they want to exert that influence. And again, there'll be restrictions and strings with that, and that's one of the other reasons for not wait to see what they're going to end up doing with the eventual PPP forgiveness. But I mean, to me, this is just part and parcel of the whole system, where they can't help themselves. They overcomplicate even the simple.
Well, and I can speak to the complications of a individual tax return. When I was first starting off my career in accounting, I did volunteer tax return through the VITA program, and it was essentially free tax preparation for low-income individuals. And the amount of rules and regulations around like earned income credit or a child tax credit or all this stuff that you'll probably never see in an accounting, if you're even if you are an individual tax preparer at a tax firm, you probably would never see these things, because they're aimed at people that usually don't pay or don't have the money to pay a professional to prepare their taxes. And the amount of rules and regulations and training you had to go through to do this was quite substantial. And the number of rules and flow charts and booklets that they would give out was astounding, for a free tax preparation, and for a low-income families or low-income taxpayers was hefty, to say the least. And but I'm with Ty, man. I kind of stay away from that, and I tell everybody I'm not a tax accountant, because everybody's asking their tax questions, right, on how this is going to affect me, how do I pay no taxes this year? You're an accountant, you know that. I don't know. So.
Well, and I hate to harken back to one of the previous articles that we talked about, but talking about if you're going to be the one doing the change, that's what gives you job security. It's like, well, if you're in an industry that is constantly changing, that then bakes that element right into what you're doing, so that even though you're doing the same thing you've always done, that industry is constantly evolving and keeping out new competition, sort of a thing. And so that's, another interesting take on it.
All right, Jack, I'll throw it to you for the final article.
Okay, yeah, this final article is Entrepreneur Magazine, and I think the timing is kind of interesting, because it was actually December of 2019, and it's talking about the need to develop multiple revenue streams for your business. So it's not like it just came out December of 2020 and was looking back talking about COVID. This was before COVID, and I guess there's a few business owners that probably wish they would have followed that advice. But I mean, you just look. We've talked about the restaurant industry quite a bit in this group, and I mean, you can look at that one, and most of them are set up to have dining room in-house service, but many have gone to takeout, delivery, outdoor. There's several states where they didn't have an outdoor patio, but a lot of them now are hurrying up to build outdoor patios because they're able to service more people because of that, and in some cases only because of COVID. What I think is interesting is you could also apply this to your personal life, because they go in there and they talk about having at least one income stream that you can control. And I kind of scratched my head on that one. I don't know if there's such a thing that's 100% that anybody can control. But I mean, if you look in your personal life, I do business advising, I do business brokering, I flip houses. I mean, you'd have to hope that at some point in time, one of those three dogs is going to be hunting for you. And this is where, earlier on we were talking about work ethic, and it's always easier for the older generations to beat up on the younger generations and say, they don't have a work ethic or they don't do this. But one point I will make is I believe the younger generations are a whole lot more entrepreneurial and risk taking than these older generations. And I think I think that's going to bode well for them, because I think is the economy. I mean, you're going to have to roll with the punches a little bit, and I think you're going to be able to. You're going to have to approach your career with more of an entrepreneurial bend. The days of going somewhere and working 30, 40, 50 years, I mean, those have kind of been long gone, but I think if you want to tie your future to corporate America, there's probably nothing worse than being, somebody in your 40s or 50s and getting the rug yanked out from under you just when you have a high mortgage payment and 2 or 3 kids going to college. So I think this younger generation embracing entrepreneurism like they do, I think that's going to bode well for them in the future. And in their just general approach or any business they open up, it's almost naturally they'll have multiple revenue streams to their business.
I thought one interesting thing you said there, Jack, was, have one source of revenue you can control. And my mind immediately went to one source of expenditures that I could control. And I guess I can only control 50% because I'm married. So I can only control my expenditures. My wife's on her own and she's got her own ideas of how much money she's going to spend. But I would look at, this is a pre-pandemic article, but I would look at, and we've talked about on the podcast before, is the pandemic for being an accelerator for a lot of things. And I think it's accelerated how business is done. And like, for an example, there was recently a bill passed where cocktails to go are now available. And I remember, Louisiana, or like the Big Easy, was the only place really in Las Vegas that you could get a drink inside and take it somewhere else with you. And now that is, essentially to help bars and restaurants survive. They've allowed cocktails to go now. And so I see it as an acceleration as to, like kind of what you're allowed to do in business and kind of opening up those business opportunities during the pandemic. And where, laws changing, people's attitude towards, virtual happy hours or virtual, business meetings and such like that has really expanded during the pandemic. So I think, I think there's opportunity. We talked earlier about opportunity in, the face of a crisis. I think there's opportunity here, but you have to be agile to be able to do it. If you were a liquor producer that was waiting for this cocktail to go, for instance, to be able to, go live with it, you had to do some run up to that and be ready to do it. It's not like you could just put, Sprite and soda and some vodka in a bottle and, send it in a 32-ounce to-go cup to somebody. I mean, you had to have some preconceived notion on how this is going to be done. Nobody wants a flat Sprite and gin, when they get home. So I don't know. I think there's opportunity there. You just have to look for it,
I think we've hit the cocktail hour. AJ's starting to imagine all his post-podcast drinks here.
Yeah.
But one of the things, Jack, I'm going to play a little bit of devil's advocate here for you, because this article talks about having 8 different revenue streams, which in theory sounds great. But as I'm reading it, I'm like, are you starting to become the jack of all trades, master of none, where you're focused so much on getting 8 different streams going that you're never focusing enough on one to make it excel or really work for you. And I mean, I'm sure there are different ways to leverage that. And this article also talks about having passive income streams, which is always great. But I'm curious what your thoughts are on that.
No, it's interesting that you say that, because I also see that. If I think of a business and, unless you're a pretty big conglomerate, it's going to be very hard to identify 8 different revenue streams and still be able to describe what it is you do. And I'm a believer in that one too, that you need to, and rather than, I guess, controlling a revenue stream, I would rather see you're a master at least one revenue stream. There's something that you kind of do, you do very well. You can have some ancillary complementary things, but I think you raise a very good point. If you dilute what you do very well by trying to get into a bunch of other things that you don't do really well, you run the risk of tanking the entire business.
Yeah, I think from my personal experience, because I've always been on the end of having multiple revenue streams in ways that are really unusual and crazy by a lot of people's standards. People here know that I taught at university, and I taught a pretty hefty load while still working in public accounting, and then working in Big Four public accounting on top of that. And that's I would say among my colleagues, that was a pretty unusual thing to be doing. And at first it kind of started with, oh, well, I had one foot in the door of academia, and I didn't know where I wanted to go with that. And I wanted to keep that going, and it's something I enjoyed. But eventually it did become, I think I did develop a psychology of just never really being comfortable with having my fortunes and my everything kind of devoted to a single cause, or to a single employer, and in a very kind of extreme way, because most people do that, right? And they work with one employer at a time. My wife does that. Other colleagues I have in our industry do that. And so what I concluded a while back is this way of operating that I have, of having multiple revenue streams. I mean, even today, we run TCA and we operate TCA, and then we've got the revenue that comes into it from various clients. So it inherently has multiple revenue streams, but then I've got other things I do outside of TCA as well. And I can't seem to stop myself from doing it. But I concluded years ago, it wasn't about me thinking I was going to make more money doing that. It isn't, because my colleagues who don't operate the way I do make as much or more money than I do, is what I've come to realize. And so, even if it's like the same, like I make the same, they make the same, it's really just a mindset. It's what they're comfortable with versus what I'm comfortable with. Right. And there's I get a certain comfort and able to sleep at night knowing that my entire fortune isn't all wrapped up in a single employer, so to speak. And while at the same time, I know that I actually have more stress in some ways than my colleagues who basically have one thing to focus on, and instead of the multi different things to focus on. So I would say that the advice of having the multiple income streams, I would say it's not, I don't really think of it as a universal truth that doing that leads to totally better fortunes. I think it's what works for you, what makes you most comfortable. Where do you sit because certainly I've kicked myself many times and think, had I been more focused at different times in my career, I surely would have been farther ahead financially or career-wise in some ways than I am today. And I see Jack laughing, and I think probably he has the same problem I do. So, yeah.
I would have said almost word for word what you said about having colleagues, and to some extent, I think I've chased my tail furiously for many years trying to be different, so to speak, and I'm where you are. I mean, I think back on some of those, maybe I should have just done with a lot of you'll go out on a Friday night with friends and they'll sit in corporate America and it's the same job, and to your point, they'll make as much or more, and that works for them. But I mean, I guess I never really wanted to felt control. And to your point, I don't think it was ever about being, a tycoon or anything like that. It was just, it made sense for me. It was a mindset for me. It was freedom for me. And you figure if you've got 3 or 4 things going and one of them gets pulled away from you, you've still got something going. Those people, and knock on wood, I've seen some of those people lose those jobs, and it's an instant panic because their income goes from 100 to 0 that quickly. But listen to you talk, Ty, I would have said almost everything you said word for word.
Yeah, I can only kind of speak from my experience, but I can just say that I feel more objective in each kind of individual revenue stream if I'm working on kind of multiple clients or different jobs, to where you can look at each situation and a little more abstracted, because you don't feel as invested in each one individually. And so you can kind of take what you've learned from, anything else that you've done and apply it there and not feel like all your eggs are in one basket. And so, yeah, that for me has been a really kind of easing feeling. All right, everybody, that's been our podcast. Thanks for watching and listening to the None of Our Businesses podcast and YouTube show. Tune back in again next week for more business updates from an accountant's perspective. Thank you.
Thanks, everybody.
Yeah.
Thanks. Thank you.